Welcome to the deep dive. Today, we're skipping the official speeches, the prepared remarks, and diving straight into where the real action often happens.
Exactly. We're looking at the Q&A. Specifically, the Q&A from Rocket Companies' recent Q3 2025 earnings call.
Right, because that's where you see what Wall Street analysts are really worried about or, curious about. It cuts through the polish.
It really does. You see the pressure points, where the market needs reassurance or sees potential pitfalls.
So our goal here is simple. Quickly break down those key questions for you. We saw analysts hitting hard on, really three main areas.
First, the money side, right? The immediate financial picture, Q4 guidance, and looking further out.
Then the huge elephant in the room making these massive acquisitions, Redfin and Mr. Cooper, actually work together smoothly, the integration piece.
And third, something they kept bringing up, AI. How artificial intelligence is actually changing their business, not just as a buzzword.
Okay, let's start with the financials then. Q4. Analysts always get nervous about Q4.
Yeah, Jeff Aiden from Morgan Stanley jumped right on that. He wanted to know about the core performance, like Rocket without the recent big buys. How's the base business holding up?
And Q4 is tough, usually. Fewer working days, holidays, things slow down. Did leadership admit that?
Oh, yeah, they acknowledged the seasonality. You kind of have to.
Right.
But then they immediately countered it, said their purchase pipeline, get this, is at record levels.
Record levels in Q4. That's a bold claim against the usual slowdown.
It is. And Brian Brown, the CFO, he put some numbers behind it, said even just looking at core Rocket, Q3 was up 14% year over year.
Okay.
And their Q4 guidance, the midpoint anyway, suggests about a 7% year over year increase. So they're basically signaling, yes, seasonality is real, but we're gaining market share faster.
So they feel good about closing out this year, but what about further out? I heard a lot of talk about 2026.
Definitely. They painted a pretty optimistic picture for 2026. They're leaning on forecasts, Fannie Mae's, I think, projecting the whole mortgage market could grow like 25% year over year.
Oh, okay. A rising tide.
A big rising tide. But Rocket's argument is they're set up to do even better. They talked about this force multiplied effect.
Force multiplied? What does that mean in practice?
It's the combination. If rates dip, maybe below 6% as they hope, that helps everyone. But then you add their new scale. The Redfin leads coming in, the huge Mr. Cooper servicing book for recapture.
Ah, so they capture more of that returning tide because they have more nets in the water, essentially.
Exactly. Better lead flow, a built-in customer base from servicing, new revenue streams. It all adds up to why they sound so confident about outpacing that potential 25% market growth.
Okay, but that confidence, that whole force multiplier idea, it all hinges on making these mergers work, and work fast, which leads right into the second big theme.
You read my mind. Integration. Analysts like Mi Bhatia from Bank of America, Dugardner from UBS.
Yeah.
They were pushing on this. Show us the proof. How fast? How real are these synergies?
And often companies get vague here. We're making progress.
Not this time. They were surprisingly specific, especially about Mr. Cooper, the servicing giant they bought. The timeline they laid out was, frankly, impressive.
Okay, give us the highlights. How fast are we talking?
All right, check this out. Day one, they slap on the new name, right? Mr. Cooper, powered by Rocket Mortgage, branding debt.
Standard stuff.
But then, day 9, 40,000 leads pulled directly from that new servicing portfolio into their mortgage pipeline.
Whoa, okay. 40,000 in just over a week. That's significant.
It is. And maybe the most eye-popping stat. Day 12, they closed the first loan for a Mr. Cooper client using Rocket Mortgage. Turn time, just 3 days.
3 days, hold on. From application to close in 3 days, especially during a huge integration like that.
That's what they reported. They stressed that the tech platforms, servicing and origination were basically talking to each other, loan officers onboarded, all within 30 days. And they made a point of saying 0 client disruption.
3 days feels aspirational, like the best case scenario they highlighted for the call. Was there pushback on whether that's actually repeatable or just a showpiece?
That's exactly the kind of skepticism analysts have. Leadership's response was basically, look, the plumbing works. They insisted the tech integration was smooth, the infrastructure handled it. That 3-day close wasn't the average maybe, but it proved the capability. It showed the potential speed they now have, which, is a huge selling point.
A massive competitive edge if they can maintain anything near that consistently. Okay, what about the overall synergy target? That $500 million number keeps floating around.
Still the target, $500 million total. They break it down. $400 million from expense savings, cutting overlap, streamlining operations.
Right.
And $100 million from revenue synergies like those 40,000 leads turning into actual business.
Yeah.
And they sounded very sure about the expense part. Said the $400 million is identified, they have line of sight. Basically, the cost-cutting plan is locked in.
Okay, so the expense side seems solid in their view. What about the Redfin side, the brokerage integration? How's that going? Specifically, that attach rate.
Yeah, the attach rate, how many Redfin homebuyers actually use Rocket for their mortgage, that seems to be going really well. Better than planned, actually.
Really? What are the numbers?
It started around 27% when they kicked things off.
Yeah.
Now, just 4 months in, it's climbed to nearly 40%. Their target is 50%.
40% already is a big jump. Why so fast? What's making Redfin buyers choose Rocket?
They pointed to two main things. One, just the clear branding. Redfin powered by Rocket makes it feel seamless.
Okay.
And two, the offer itself. They have this compelling bundle with special pricing called Rocket Preferred. So there's a real financial incentive for the customer to stick within the ecosystem.
So better branding, better pricing. And you mentioned earlier they want to put refinance options into Redfin, move the mortgage app into the Redfin app. It sounds like they want to own the whole process, start to finish.
That's exactly it. When analysts talk about Rocket shifting from just a mortgage lender to a homeownership company, this is what they mean. It's vertical integration. Control the search, the finance, the servicing, keep the customer sticky.
Makes sense. But building and integrating all that, especially at speed, it relies heavily on tech, right? Which brings us to AI.
Perfect segue.
Yeah.
Yeah, analysts Ryan McGavone, Mark Dice, they were definitely digging into the AI angle. How is it actually helping scale the business, especially with this huge new servicing book and, handling market swings?
What was the main message on AI in servicing those 10 million Mr. Cooper clients?
The headline was bold. AI is the future of servicing, period. Think about all the routine stuff, payment help, questions about taxes, forbearance requests. AI can automate tons of that.
Freeing up humans for complex issues.
Precisely. And they mentioned partnering with a company called Sierra, an AI-first company, they called it. The goal isn't just chatbots. It's building fully automated digital assistants, 24/7 available, that might even predict client needs before they ask.
Predictive servicing. That's a step change from just reactive Q&A.
Huge leap. But AI isn't just future state stuff for them. They talked about how it helped recently. Remember that rate dip in September? When the 30-year briefly touched 6.3%.
Right. That probably caused a flood of inquiries.
Exactly. A massive spike in volume. Normally you'd scramble, higher temps, huge cost, slow ramp up. Instead, they said AI handled a lot of the initial interactions. Chat, website stuff, messenger.
It acted as a buffer, a capacity expander.
That's the idea. AI takes the routine questions, the document gathering, the follow-ups, the non-revenue generating tasks. It lets the human loan officers focus on the complex advice, the relationship building, actually closing the deals.
And did they quantify that benefit?
They did. Claimed their production team members can handle something like 63% more loan volume now compared to just 2 years ago, largely thanks to AI taking that busy work off their plate.
63% more capacity per person. That's a game changer in terms of efficiency and cost per loan. It creates a real advantage.
A huge advantage, especially when volumes fluctuate wildly like they do in the mortgage market. Being able to scale up capacity without massively scaling up fixed headcount costs. That's the dream.
Okay, final area the analysts pushed on: strategy, market share, and any potential roadblocks like regulation. Bose George from KBW asked about market share targets.
Yeah, basically asking, are you still confident you can hit those ambitious goals, especially with all this integration churn?
And the answer?
Still confident. They laid out their 3 pillars for growth. 1, Redfin brings in the buyers, early 50 million monthly visitors, they said. 2, AI makes the whole process faster and cheaper. 3, that massive 10 million client servicing book is a ready-made pipeline for future loans, move-up buyers, refis.
So they believe the pieces are in place. Did they give a new market share number?
Not yet. They sort of hedged, saying they're on track for current goals, but will update the targets later once the Mr. Cooper share is fully baked into their baseline. Give it a few quarters.
Makes sense. And the regulatory question. Terry Ma from Barclays brought up the FHFA servicing cap, the 20% limit. Is that going to slow them down?
They pretty much brushed it off. Said caps aren't new. Regulators care about responsible integration, strong capital, good liquidity.
And Rocket feels they meet those standards.
Their message was clear. Capital and liquidity are well beyond what's required. And they mentioned a confidential agreement with the FHFA giving them sufficient room to grow and hit those synergy targets, maybe even exceed them. So the takeaway was, regulation isn't a near-term obstacle for their plans.
Wow. Okay, so pulling it all together from that Q&A, it really feels like the market, through the analysts, is grappling with this idea of Rocket becoming something bigger, not just loans anymore.
Absolutely. It's that shift to the integrated homeownership company. The questions kept coming back to, can you pull off this integration? Can the tech, the AI, really deliver these efficiencies?
And the data points they threw out, that 3-day close, 40% attach rate, 40,000 leads.
Right.
Those are meant to scream, yes, we can.
Right. And you have to remember that $500 million synergy target. That's the number everyone's watching.
Definitely the benchmark.
Which, leads to a pretty interesting thought for you listening. Rocket talks about AI building a foundation for infinite capacity, growing loan volume potentially massively while keeping fixed costs relatively flat.
Infinite capacity. That sounds like hyperbole.
Maybe. But if they get even close, the big question for the whole financial world isn't just how much market share they gain. It's what happens when human bandwidth stops being the main constraint on growth for these huge institutions. How long until that's the reality?
That changes the fundamental economics of the business, something to definitely mull over. Okay, that wraps up our deep dive into the Rocket Companies Q&A. Thanks for tuning in.
See you next time.